Welcome to the Explainer. Every single year, millions of people are paying way more in taxes than they legally have to. And it's not because the law requires it, and it's definitely not because they did anything wrong. It's simply because nobody ever sat us down and taught us the actual rules of the game. So today, we're going to flip the script. We're going to look at the tax code not as this frustrating, confusing burden, but as a rule book. And we're going to decode that rule book together right now so you can legally keep a whole lot more of your hard-earned money.
Seriously, I want you to think about this for a second. Are you paying too much? The reality is, millions of us are just quietly letting our own money slip away year after year just because we don't know the rules around deductions. I mean, nobody taught us this in school, right? But today, we are fixing that exact problem together. By the end of this explainer, you'll know exactly how to stop overpaying and start saving.
Okay, let's dive into this. Here's our roadmap for today. First, we'll talk about the money you're leaving on the table. Second, we'll break down the difference between an exemption and a deduction. Third, we're getting into the big 6 deductions. Fourth, we'll walk through a real-world example looking at our June savings. And finally, number 5, we'll cover the 3 most common tax mistakes you need to avoid.
All right, part 1, money left on table. Just a quick recap. So remember that income tax is strictly calculated on your taxable income. What deductions and exemptions do is shrink the number that your tax is calculated on, which means you pay less. It's that simple. Every single missed reduction is literal cash coming right out of your pocket. Think about that for a second. If you miss claiming a deduction you're entitled to, you're essentially volunteering to hand the government extra money. It's a direct leak in your wealth, and we're going to plug that leak today.
Moving on to part 2, exemption versus deduction, the foundation. Now, people throw these two terms around interchangeably all the time, but separating them conceptually is absolutely crucial. First, you have an exemption. This is income that is completely excluded before your taxable income is even calculated. It never even enters the picture. A great example of this is your house rent allowance, or HRA. Then, on the flip side, you have a deduction. This is an amount that gets subtracted from your income after it's already been counted. So you invest a certain amount, and then you get to deduct it from the total. Basically, the math flows like this. You start with your gross income, you subtract your exemptions right off the bat, then you subtract your deductions later, and boom, that equals your final taxable income. Ultimately, the practical effect of both is absolutely identical. Your final taxable income goes down, which directly lowers your tax bill. The only real difference is just when in the mathematical process that reduction actually happens.
Okay, part 3, the big 6 deductions. This is your arsenal.
These are universally applicable tools that can literally save you thousands. And hey, while specific names and limits might differ depending on what country you're in, these broader categories apply to almost everyone. First up, we've got investments and savings. The government actively rewards you for long-term saving. For instance, in India, under Section 80C, putting money into your Provident Fund, pension schemes, or ELSS mutual funds can score you a deduction of up to 1.5 lakh rupees. It's just an incredible incentive to build your own wealth for the future, all while paying significantly less tax today. Let's keep that momentum going with health insurance premiums, which fall under Section 80D. You can claim tax deductions ranging anywhere from 25,000 to 50,000 rupees for medical insurance premiums paid for yourself, your spouse, your kids, or even your parents. Protecting your family's health simultaneously protects your wealth. It is a massive win-win that you should absolutely be taking advantage of.
Tool number 3 in our arsenal is education loan interest, under Section 80E. Investing in higher education gives you a massive financial advantage, mostly because the interest you pay on loans taken for yourself, your spouse, or your kids is typically fully deductible for several years. Basically, the government is subsidizing the cost of your family's higher education through tax breaks. How great is that?
And then we have our next massive tool, the home loan interest deduction, under Section 24B. If you're paying off a home loan for a property you actually live in, you can deduct up to 2 lakh rupees of the interest paid. Across the board, this is universally one of the absolute largest tax breaks available to salaried individuals and business owners alike. Coming in at number 5, we have charitable donations under Section 80G. Giving back is obviously a fantastic thing to do, and the tax code completely agrees with you. Depending on the registered charity, relief fund, or nonprofit that you donate to, you can deduct 50% to 100% of the donated amount. It just goes to show that giving back to your community directly lowers your overall personal tax burden.
Let's wrap up our rapid-fire Big 6 with the standard deduction. In India, this is an automatic, flat 75,000 rupee reduction given to all salaried employees. And honestly, the best part about this one?
It requires absolutely zero proof. No receipts, no bills, nothing. It's literally just an automatic shrinking of your taxable income to compensate for general work-related expenses.
All right, moving to part 4. Let's look at a real example with Arjun's savings.
Let's ground all these abstract concepts in some real-world math so you can see the power of this. Imagine Arjun. He's an average salaried employee earning a gross income of 12 lakhs a year. Let's see exactly what happens when he effectively uses the arsenal we just talked about. Right away, he gets that 75,000 rupees standard deduction. Boo! Then he claims 150,000 rupees for Section 80C, covering his PF and investments. Next, he claims 25,000 rupees for his health insurance under 80D. And finally, he claims 200,000 rupees for his home loan interest under 24B. With all that, his taxable income plummets to just 7,50,000 rupees. Without these deductions, his tax bill would be sitting around 1,12,500 rupees. But with the deductions, it drops to just about 37,500 rupees.
So here is the absolutely crucial point. Arjun legally saved 75,000 rupees, and that's every single year. He didn't do anything shady, nothing special, nothing risky. He saved this money simply by using deductions on things he was already spending money on anyway, like his home loan and his health insurance. He just knew the rules, and he knew exactly what to claim.
Now, I do have to throw in a quick but necessary guardrail here. The example we just went through is illustrative only. Tax rules do vary by year, by country, and by specific tax regimes. Your actual tax is going to be affected by things like surcharges and cess. So always consult a tax professional or check official government sources to calculate your exact final numbers.
Which brings us to part 5, 3 common tax mistakes, basically our guardrails.
Let's quickly count down these pitfalls so you can avoid them. Mistake number 1. Waiting until March to plan your deductions. Please do not panic buy insurance you don't even need at the very end of the financial year. Plan intentionally right at the start. Mistake number 2, not keeping organized digital proof. Claiming a deduction without documentation is a massive risk if you ever face a tax scrutiny. Keep those digital receipts organized and backed up. And mistake number 3, assuming deductions only apply to salaried employees. Freelancers, business owners, listen up right now. These apply to you too, plus you actually get extra deductions for business expenses.
So, to bring this all together, exemptions reduce your income before accounting, deductions reduce it after, but both legally lower your taxable income. We built your arsenal today with the big 6: savings, health, home, education, donations, and the standard deduction. Remember, deductions save you money on things you're already spending on. Just plan early and always keep your documentation. Now, in our next explainer, we're going to be diving deep into the mysteries of TDS, tax deducted at source. You know, that mysterious little number that quietly leaves your payslip every single month.
But before you go today, I really want you to think about this final question. Which deduction surprised you the most today? Drop your answers down below. I would absolutely love to read them and see what clicked for you. And hey, if this explainer helped you realize that you've been leaving money on the table, please share it with just one person who needs to hear it. That is the best way to help us grow. Stay focused, keep learning, and I'll see you in the next explainer.